I don't think there's a fundamental market failure here in terms of pooling mortgage risks. Securitization is exactly the item. But the more fundamental problem I have is with the whole question of government insurance. And let me just run down the sort of steps that inevitably are going to occur, and they're going to have the punchline, we're going to end up with more risk, not less risk. It starts with the presumption, in fact, all government programs start with the high platitude, premiums have to be actuarially based. It's based in law. In fact, it has to be almost, because the way since 1990 or thereabouts, all federal programs that have credit guarantees either have to prove that they're actuarially fair or they have to go in front of Congress each year for an appropriation. So they're all actuarially fair. The second proposition in this proposal, though, is that we're only going to insure the safe risks, and this is just a political non-starter. Can you imagine a congresswoman going back to the district to say proudly, I just passed a government insurance program, but it only applies to those that have FICO scores over 700. You've got to put 20% down payment, and you've got to have a very high income and long employment record. Then the government will take care of you. If you don't have those, you'll have to go fend for yourself. It doesn't work. It never does work that way. So the program inevitably is going to, and we've even already heard from Mr. Geithner, they're already talking 10%, and so it's going to become risky loans. The problem is the government can never risk-based pricing, and it's the same political problem. I mean, in every government insurance program, there's always a compression of premiums. The highest risk folks say that's not fair, and political pressure is brought, and so those premiums go down relative to the true actuarial price. What it takes the form of is either a cross-subsidization, so you charge the safe risks more and the high risks less, or what actually happens is they just end up with outright subsidies. You might say, well, but doesn't the law require that they be actuarially fair? Well, John Quigley already mentioned the National Flood Insurance Program. It's been in existence for 40 years. It always says it's actuarially fair until Katrina. Now, when they had to go in front of Congress and ask for a $25 billion bailout, and Congress said, but wasn't it actuarially fair? They said, well, not really. We had a 40% subsidy. We just never put away money for the big one. And that's the story across the... So what happens here eventually with any government insurance program is we subsidize the high risks, and we actually encourage taxpayers, whether it's the taxpayers who are providing the insurance or the policyholders, to put themselves in harm's way.